Hi, good morning. It's 9 o'clock and falls to me to welcome you to BDO's seminar on reorganisation in a COVID world. Whilst you are unable to see colleagues attending, we do have more than 140 delegates ranging from HEI board members and executives, leading legal firms, banks, the DfE and the OFS. I'm James Aston and I'm chairing today's session. Just to start with, there are a few housekeeping points. This session will be recorded and a copy will be sent to you later this week. Do by all means share with your colleagues. Given the size of the audience, everyone will be on mute. My colleagues will be speaking for around 45 minutes, leaving 10 to 15 minutes for questions and answers. If you do have a question, please use the Q&A button. It's in the middle, bottom of the screen, to send the questions to the panel, and I'll collate these as best I can through the session. If there are matters you prefer to voice privately, details of today's team will be circulated, or just contact me and I'll make sure you get through to the right people. So a number of you on this update will know me, but for those who don't, I lead BDO's education team and I've worked as an advisor in the sector for over 30 years. Over that time, I've been on a number of Secretary of State direct appointments and have worked directly for the DfE, ESFA, HEFGE and the OFS. When I joined the firm 18 years ago, we were auditors to just 2 HEIs. I set out to build the best audit practice I could, and we're now external auditors for 39 HEIs and advisors to another 20. In the last 5 years, I've concentrated on widening our advisory services in education, and we're now very much focused on becoming the best professional services firm in the sector. I've built a national team, and we work quite differently from our peer firms. I focus on expertise and sector knowledge with strict licensing so that anyone you meet from BDO in an HEI setting is highly fluent in sector issues and really is a true expert, not so simply a resprayed generalist. Today, I've brought together just 5 of my senior colleagues who work with our education clients on reorganising their operations, and whether from deep financial stress or enhancing operational effectiveness. They'll share examples of good practice, war stories and knowledge. I'm delighted to introduce Matthew Tait as our first speaker. Matthew.
Good morning, everyone. Hopefully you can hear me on the call. My name is Matthew Tait. I'm a business restructuring partner, and with my colleague Tim Betts, I jointly lead government and not-for-profit substream for business restructuring at BDO. Today, we're going to give you an insight into some of our advisory work in the higher education sector and demonstrate how we leverage different skill sets to service individual client needs, as well as the needs of the sector as a whole. We are focusing on the subject of reorganisation and have set this in the somewhat obvious context of the pandemic. In particular, we're considering the impact and changes that are here to stay as we go back to normality, fingers crossed. And we've chosen very specifically the word reorganisation, as it encompasses a large number of activities that we think the sector will be trying to get to grips with, and that's all aspects of the sector, both lenders too, as well as advisors, as well as the HEIs themselves. But in particular, the questions such as how to structure and organise and transform to become a fit for post-pandemic HEI. Secondly, how to embed operational and financial efficiency into what is quite commonly a complex organisation in a complex setting. And thirdly, how to become resilient yet flexible. These being terms that I think will become synonymous with the terms in the sector of viability and sustainability. So how are we going to do this? Well, the answer is in 3 ways. Firstly, you will have me. I will be giving you my observations on what we thought would happen and what did happen from the beginning of the pandemic to today's date, how that has changed the stakeholder landscape and their expectations. What do we believe from a financial restructuring perspective will be the challenges and changes going forwards? What can we learn from the past to inform the future? Secondly, we'll look at the dynamics of operational effectiveness, highlighting areas of focus and opportunity specific to the sector. And finally, we'll address the newly emboldened stakeholder on the block, the University Superannuation Scheme, And we'll also look at the sharp focus that senior leadership teams in HEIs will need when looking at issues raised by the Pensions Act. So to begin with, let's go back a little. Right from the start of the pandemic and the ensuing lockdowns, government recognised that HEIs needed immediate and significant financial support. Now, this came in two main ways. On the left-hand 4 blocks of the slide, you can see examples of specific HEI support. For example, the cash flow kicker of £2.6 billion of brought forward student loan company payments. Now, the the right-hand box then shows the general access to support measures that the Chancellor assisted the economy with. As now, on top of that, there were relaxations and suspensions of various policies and statutes, including those relating to directors' duties. Now, there are numerous reasons why the government did this for HEIs and for the sector, but I pick on deliberately 3. Firstly, global value. The HE sector positions the UK front and centre on the international stage, and it made a surplus in 2018-19 of about £1.5 billion. So clearly it needed protecting. Secondly, the focus was there because of the delivery mechanism, similar in some ways to retail, and indeed one of the many attractions to those studying is the in-person, person-on-person experience of collaboration and learning. Thirdly is what I will dub, I think others do too, is the international subsidy. In recent years, home student numbers have remained relatively static, but the growth has been in the international base, with almost 350,000 international students in 2018-19, or 14% of the 2.4 million students at UK universities. Now, of this, China was by far the largest source with 120,000. So these students are a vital financial pillar that supports delivery, research, and investment. Now, I picked on those 3 deliberately, as I said, because they can be converted into questions. And the questions are as follows. How will post-COVID fiscal tightening and policy change, whether that's funding policy or political priority, impact the sector and the subsectors over time? Secondly, what will be the changes to the models for and modes of delivery of, and how will this modes of delivery, and how will this affect prospective students' attitude and expectations of the sector, in particular their preparedness to enter into long-term financial ties with it? And thirdly, how do we understand the financial and operational efficiency metrics when some of the cornerstones of the standard model have been deeply shaken? In its early stages, the serious concerns for the financial impact of COVID probably best summarised in the Evening Standard's article of the 6th of July under the alarmist headline, 13 universities could go bust. A number of the fears, though, expressed in that article, as well as others, are summarised on the left-hand side of this slide. Broadly, they relate to loss of income, loss of students, and loss of delivery mechanism. But the Institute for Fiscal Studies report, upon which that article, as well as many other articles, was based, I think it went too far, because it went on to say that for around a dozen universities, insolvency is likely to become a very real prospect. Now, I am a licensed insolvency practitioner, and so I take that term very seriously. In my view, insolvency is not a broad financial term, but a complex and specific legal condition. It is specific to an entity's legal character, very important, and its true financial position. So it's something I'm going to touch on a little bit later. On the right, we have a more up-to-date view. As you see, the sector as a whole has actually proved to be extremely resilient. So while some of the concerns have played out as predicted, a number either haven't or they've changed. So for example, there is anxiety and remaining anxiety about income levels and the sources of those income levels, as well as the international student subsidy. And these are in part exacerbated by Brexit and research funding angst. But I think focusing on numerical and financial data alone misses, for me at least, one of the main challenges to reorganisation post-COVID. And that's best summarised in the government's July 2020 scheme for HE restructuring regime, what I would call the regime. That regime sets clear expectations of how restructuring and reorganisation should work, and then in one short sentence marries that to the regulatory focus on the student as the lens for all measurement and judgment. Now, that's not necessarily a happy marriage, as whether caused by the pandemic or accelerated by it, there are a number of new parties who have to be invited to that wedding, but they may have different priorities. So there could be a fight brewing in the queue for the buffet. This dynamic and complex environment is something that we at BDO have market-leading experience of. The shift in power, risk, and need, the creation of agreed platforms of information to meet differing stakeholder expectations, the changed requirements of and relationships with those stakeholders. We have seen this in other education sectors and successfully helped navigate our clients through it. To respond to the significant challenges brought by COVID, BDO developed the Rethink framework. The framework is sector and size agnostic. It helps clients to carefully, patiently, and critically define their response to changes brought about or accelerated by the pandemic, and then how to systematically appraise and prioritise those issues before making sustainable, lasting change. The diagram on the screen is the Rethink framework at its most simplified. We have a wealth of material available on our website, but it's easy to access via bdo.co.uk/rethink. For now, I just want to introduce you to the 3 key phases of Rethink and see whether this strikes a chord with you before moving on to where I think we are now and how the progression through will influence the reorganisation of HEIs. So very briefly, stage 1 or phase 1 is React, where initial risks are assessed, immediate crisis management actions are taken, working capital adequacy is focused on, and key suppliers are identified and contacted and communicated with. Critically though, business planning is based on government policy. So the closing of campuses whilst accessing government support schemes, or negotiating lending covenants, lending covenant resets, or their suspension is a prime example of a React phase. Stage 2 is resilience, where changes to operations brought in response to the first stage are maintained using techniques that allow people and processes and information systems to adapt to changing patterns. The move to digital delivery, for example, occurred during the resilience stage. Stage 3 is realise. That's where I placed the dot. Realise is applying the learnings from the key React and resilience activities and continuing to adapt, possibly to a new business model, but most critically in a way that addresses essential and obligatory economic, financial, socio-cultural and technological change. To put the Realise phase in a financial context, and to still liberally from the IFS, Universities UK and HESA reports, pre-pandemic, the sector operated unevenly, of course, with around 45 billion reserves and an annual surplus of around 2 billion. Borrowing as a percentage of income had increased from around 20% 10 years ago to over 30% roughly pre-pandemic. So many of the assumptions that supported that structure are now at the very least challengeable. As I said earlier, not all of the fears for the sector have played out, but what has happened in my mind at least is a permanent change to the relationships with some critical stakeholders and the changed approach those stakeholders will adopt in a reorganisation. Across the bottom of the slide, I have grouped these stakeholders into 5. Government and regulatory, lenders, pensions, competitive markets, and last but not least, students. So I've identified the players, but what about their positions? In our experience, the difference between a good plan and a bad plan comes down to the approach. One indeed very logical approach would be to use the restructuring regime's guidance as a playbook. It's clear to me as someone who works in restructuring that guidance has at least some connection to corporate review and restructuring methodology. Under the heading of efficiency, the guidance in the regime asks HEIs to review administration costs, identify cost savings and efficiencies, as well as considering, and this is where it becomes a little bit more extreme, selling or repurposing assets to repay loans or to fund restructuring itself. And finally, it suggests modelling the closure of unviable campuses and considering options for merger. So these might sound unpalatable, but they're drawn from the corporate restructuring world. So therefore, it's informative. Our considerable experience of addressing exactly these considerations in other contexts tells us just how challenging this is and just how much can be gained by carefully considering the approach. Now, I have the unique experience of having been personally responsible for the delivery of a micro-detailed and costed student protection plan as administrator of GSM London Limited. For those unfamiliar, GSM was a for-profit, private equity-owned institution with significant bank borrowings. It had over 3,500 students, a large proportion studying for degrees in business management. Following months of detailed planning and analysis, and in close coordination with a number of bodies, including the Office for Students, UCAS, the DfE, and the Student Loan Company, all students registering an interest to do so had their provider moved to one of 43 other HEIs. Quite a task. This experience, together with that gained elsewhere in far less dramatic circumstances, informs my view that there are 4 sector-specific pillars that need to be addressed at the outset. Firstly, the legal and governance structure. This is a real feature of the sector, and ignore it at your peril. The restructuring regime may say sell an asset, but what if that asset, due to some long-standing right, can only be used for distinct educative purposes? Another example, if you understand who your stakeholders are you as an HEI organised in such a way that you can meet the decision timetable that, for example, a lender's structures then dictate to you? Second block is information. The expectation of stakeholders in this new paradigm are informed by their internal processes and their experiences gained outside of the sector. Can the HEI identify and then address these new requirements and more positively gain lasting benefits from it? Experience tells me that a particular focus will be communicated, will be required on an integrated estate and curriculum plan, but in a way that can be reviewed and challenged financially as well as operationally. Thirdly, stakeholder priorities. For example, and for many reasons, lenders' more relaxed attitude, in inverted commas, to unsecured lending has ended, a reflection of increased actual or perceived risk, for which it reads increased uncertainty in the sector, and the cost impact that has on the lender's own cost of capital. All this has been exacerbated by statutory developments elsewhere, most specifically in FE. And lastly on the list, regulatory priorities and developments. As discussed earlier, but to repeat an earlier observation, irrespective of prevailing borrowing costs, economic shocks have fiscal and other consequences. At the outset, I said our education team, quite quietly, has amassed unrivaled advisory experience in the sector. So I'll end by sharing this slide with you, which has some thoughts of those lessons learned. For the webinar, I'm just going to expand on 3. Firstly, the direction of travel, in my view, is towards corporate-style independent business reviews in support of reorganisations and restructurings. This is signalled very clearly in the HE restructuring regime. This may present a changed dynamic between the lender, funder, and provider, and it will be challenging. Having someone in your team who understands through experience the sector and stakeholder perspectives from all sides seems to me a sensible step. Secondly, because of the changes brought by the pandemic, there is an elevated need to adopt what I'm calling the 3 O's approach. Now that is open book, open mind, and open to challenge. Open book means sharing all relevant information, what we would describe as the agreed platform information, very common in corporate business restructurings. And this is the first building block for reorganisation and obtaining stakeholder buy-in. Secondly, open mind. This is a willingness to address difficult issues or ingrained beliefs positively in order to gain a sustainable benefit. And thirdly, open to challenge, which is an acknowledgement that stakeholders who in the past may have acted more passively or in a different way may now wish to question and push in new directions. Lastly, and this is for the lenders on the call really, is to truly understand how each and every engagement, plan or proposal will be informed by its impact on students. A firm fix on what that means for the HEI and the regulatory regime under which they operate at the earliest opportunity will result in better discussions and supportable plans. So what are my key messages? Number one, change has happened, either caused or accelerated by the pandemic, and modelling uncertainty will be a factor in any reorganisation for all of the stakeholders in it. Secondly, stakeholder priorities, demands and expectations have also changed, and they are key. Thirdly, you need to work with these changes and let that inform the approach to reorganisation or restructuring. And fourthly, the team at BDO is able to draw on unrivaled experience across lines of service to help you meet that challenge. So that brings me to the end of my section. Thank you for listening. I'm now going to hand to Richard Austin, who is one of the architects of BDO's Rethink framework. Richard.
Thank you, Matthew, and good morning, everyone. My name is Richard Austin. I'm Head of Corporate Advisory Services at BDO, and I've spent the last 20 years, probably a bit more than that, helping clients to improve their operational effectiveness and efficiency. And within that, I have a specific focus around helping clients to set up and establish an appropriate operating models within their organisations. As Matthew was talking about, there's been significant impact on the sector. So there's been a lot of systemic change that's going on. And then you roll on top of that COVID, and there's a significant impact and a significant level of change that's occurring within the sector. Within that, it raises a number of opportunities and risks that that you need to be thinking about. And a core part of that is really understanding the impact of the level of change that's been occurring within the industry. And as Matthew said, in terms of being able to see the future, it's difficult. Some predictions have come true and some have not. And therefore, ensuring you have a flexible and agile operating model is going to be fundamental going forwards. So as I said, improving efficiency and effectiveness and agility and flexibility is absolutely core. Clearly, there are different elements within an HEI. Some of those are student facing and some of them are not. So if you look at the diagram on this slide, you've got student support services. Those are the elements that a student feels, sees, hears and experiences. And as Matthew was saying, that student-centric focus means that those are the areas that need to be maintained and enhanced without impacting negatively the student experience. So what we're going to talk about is back office support services, which is the red rectangle around it. Clearly, there are elements of those within finance, IT, HR, etc. But those are the elements that the student does not experience directly. And therefore, ensuring that those elements are as efficient and effective as possible allows HEIs to ensure that they are flexible, agile and efficient going forwards. Within that area, I will hand over to Jenny Shutt, who will just pick up on one of those elements, which is finance effectiveness. So Jenny, over to you.
Thank you, Richard. Good morning, everybody. My name's Jenny Shutt. I'm a director in the Corporate Advisory Services team here at BDO, regularly advising businesses and organisations on their target operating models. As Matthew mentioned, the level of financial performance and deterioration is maybe not as we'd expected this time 12 months ago. However, it's really still a good opportunity to rethink the back office model and your back office function. There'll be continued uncertainties ahead, and it's going to be really key to make sure that your back office is performing optimally and it's agile and flexible, so as there potentially are changes in income that can be reflected in the costs that you experience within your back office function. So what I'd like to do today is take you through an example of a reorganisation. It's specific to finance, but it's applicable across all of the back office, just to give you a bit of an idea about how we look at reorganisation at BDO. So before embarking on any reorganisation, it's really important to understand the as-is process. So if we take this as an example, it was a higher education, a university based in London, looking at the finance function, and there are subcomponents and sub-processes within that. So record to report is an example. We looked at procure to pay, looking at the control of non-paid costs. There are about 8 different processes that we looked at. And whilst it's not common of all universities and higher educational institutions, there are some common themes. There are some themes that come out. So if we look at back office support, they've typically grown organically over time. So when we're looking at these maturity models, the teams that we're speaking to have been with the organisations for many years, so they don't necessarily know what good looks like. And we'll often ask the question, what does good look like for other universities? At which point we think that's important, but we'd also challenge to say, because it's back office, we need to be thinking, if we want to get into that excellence category of what more commercially driven businesses are looking to do, potentially in the private sector. So looking at both to understand how to get yourself from innocence to excellence. We also find that the financial acumen across the organisation can vary. FP&A tends to vary, so academics very much focused on delivering quality programmes for students and not necessarily thinking about the commercial delivery and viability at the back end. So lack of financial culture sometimes occurs in organisations as well. And then multiple systems. So again, organically grown, multiple bolt-on systems, and it's very difficult sometimes to get a single version of the truth. And the management information that's provided can be patchy to support that timely decision making. So there's opportunities typically there as well. So this organisation was performing fit for purpose. So it wasn't excellent, but it wasn't, there weren't any risks that were identified. So transactionally, it was fit for purpose of what it was trying to achieve. So once we know the maturity and the effectiveness of the process, we like to look at the cost of the function. So here we can see that the cost in relation to revenue was high. So the median was 1.1%. The cost of the function as a percentage of the revenue, and the function was actually 2.1%. And this was very much based on the fact that there was a central London location and there was a relatively top-heavy management team. And when we're thinking about this central London location, there is a question that can be posed now to say, is it really necessary, bearing in mind we've been working remotely for over a year, to have all of our team on site? So some organisations looking at the potential, either you could look to North Shore or you could look to completely move to a remote model for some of the transactional processes within your finance function. So there's some questions there to reduce the cost. And then if we look at the chart on the right-hand side, this looks at the number of FTEs in relation to revenue, and it also showed that it was performing below the lower quartile. And this was mainly driven by really poorly defined processes, and there was lots of duplication in efforts, archaic systems landscapes, which means master data systems were needing to be updated multiple times, lack of automation, and there was a particularly low skill set within the transactional team. So the effectiveness and the efficiency of the roles that they were performing wasn't great. So when we look at the maturity of the process being fit for purpose and we look at the cost being high, there is a question to say, okay, there's an opportunity to reorganise this function. So there was a relatively new director of finance. He was very aware that the budgeting and forecasting process wasn't going well. There was quite a lot of attrition with the finance business partners, so the budget holders didn't necessarily have one common contact or one regular consistent contact. Was aware that the data was patchy and that there was some duplication of effort. So what he looked to do was pull together a team where the transactional teams, so the credit control and accounts payable teams, merged, and some of that duplication of effort was reduced. An FP&A function was created to provide the value to the business, to the organisation, to make sure that they have that continuous support to be able to forecast and manage their budgets well, and implemented a budgeting system. So look to consolidate all of the information, the management information, into one single source to get that one source of the truth. So what he managed to do was increase the effectiveness of the function whilst reducing the cost of the function by reducing the number of FTEs. But then going forward, as I mentioned, it's really important to look at the processes, the roles, and see which potentially can be done remotely and what impact that will have on your pay costs, but also your non-pay costs of teams not being on site as much, and all of the pensions implications, etc., that go with the reduction of headcount within functions. So this example, there was quite a lot of opportunity. It's not necessarily going to be where the major opportunity is for your organisation, but it's really important to get a thorough understanding of where you are. And going back to the top where I started, increasing the effectiveness of the function and making sure that they are structured so they're agile to flex to any changes in income that might occur over the next 12 to 18 months, 2 years will be really important. So at this point, I'd like to hand back to Richard.
Thanks, Jenny. So effectively, there's probably two takeaways if I was to ask you to think about two things. One is not all organizations have the same challenges, but most organizations have challenges. So there are elements in here around a finance function that may be less of a challenge for you, but there may be other elements of IT or HR or other back office functions that are worth looking at. And the second point that Jenny picked up on there was around benchmarking and comparing yourself. Don't just compare yourself to other HEIs. Think more broadly and more commercially around other businesses and sectors that show best practice around back office operations. That's where I'll leave it. At this point, I will hand over to Mark, who will pick up around pensions covenants. Mark.
Thank you, Richard. Good morning, everyone. I'm Mark Costello. I'm an Associate Director within BDO's Pensions Covenant Advisory Team. And we advise a number of in-house DB schemes that are sponsored by pre-92 universities. And we've also advised in mergers and restructurings in the FE sector. From a pensions perspective, there's three things I would like to cover this morning. The first is why pension schemes would be a major stakeholder in restructuring situations within the HE sector. Secondly, just some restructuring considerations for each of the major types of pension provision within HE. And lastly, some restructuring considerations in connection with the provisions of the Pension Schemes Act 2021. Very briefly, the four major types of pension provision are summarised in the table in the top left-hand corner. So for your pre-92 universities, academic staff tend to join the USS. And there tends to be an in-house defined benefit scheme for the non-academic staff. And for your post-92 universities, broadly, it's the equivalents are the TPS for academic staff and membership of the local government pension scheme for non-academic staff. So just coming back to the first point that I said I would talk about, and that is why would pension trustees be a major stakeholder in any restructuring process? Well, according to the OFS, the aggregate borrowing for the HE sector was 13.7 billion at the end of the 2019-20 financial year. The USS has a valuation underway as at 31 March 2020, and the initial results of that show that the technical provisions or ongoing deficit for that scheme alone is 14.9 billion to 17.9 billion. And the ongoing or technical provisions deficit is basically the amount that needs to be funded through either contributions or, to some extent, investment returns as well. The 2018 valuation for the USS showed a Section 75 deficit of 50 billion, which is the amount which would apply an insolvency. So in effect, an institution's share of the Section 75 deficit would be claim of the USS in an insolvency scenario of that institution. And that's clearly more than three times the level of debt. The in-house schemes that the non-academic staff of P92 universities join, those will be, in aggregate, the Section 75 deficit will be in the billions of pounds. Certainly the clients that we have, every one of them is in excess of 100 million, and some of them are, many times that. While the TPS is unfunded, the on-balance sheet net pension liabilities relating to the local government pension schemes for the post-92 universities can amount to hundreds of millions of pounds. So what that tells us is that pension funding requirements for universities are very material relative to debt levels, and also that there's every likelihood that the USS would be the largest creditor in an insolvency of a P92 university. Turning to the second point I said I would speak about, and that's just some restructuring considerations for each of those four types of pension provision which I've spoken about. I will say a few words on each of them, but I think there's quite a lot going on in the USS space at the moment, so that will probably be the main focus of the presentation today. So just starting off with the USS, I mentioned there was an ongoing valuation at 31 March 2020. As part of that process, the USS has consulted with employers on a number of proposals aimed at protecting the employer covenant of the USS, and it includes introducing a range of measures such as debt monitoring obligations for employers, a requirement for employers to provide the USS with pari passu security when providing security to lenders, and also a moratorium on employers leaving the USS. So in March of this year, the USS provided an update on the 2020 valuation, setting out what the contributions might need to be going forward in order to maintain the existing level of benefits. And they did this under a number of different covenant scenarios. So if you look at the table in the middle column, there's effectively three scenarios there. The top line is basically what's in place at the moment. And scenario one and scenario two are the updates from the 2020 valuation, which I'll expand upon in a moment. So looking at the first line there, what's actually currently payable right now is 30.7% overall contribution. So that covers both the employer's contribution and the member contribution. The employer picks up around 2/3 of that in total contribution. However, as of 1st of October this year, that's already due to step up to 34.7%. That's under the existing schedule of contributions. On scenario one, which is effectively no change to the employer covenant arrangements that are in place at present, the initial estimate is that the future contribution rates may need to increase to 56.2%, which is more than 20 percentage point increase over what's payable at present. And under the second scenario, which is basically the proposals which the USS put forward around debt monitoring, pari passu security, etc., that would involve the employers agreeing to those measures. And even then, a contribution increase is still potentially going to be required. The initial estimates are 42.1%. And clearly, under either of those two scenarios, there's going to be an increase, but I think avoiding a 56.2 increase under scenario one is in principle at least a strong incentive for employers to agree to these measures put forward by the USS, or at least some negotiated form of them. However, saying that, there could be challenges and implications in doing so. First of all, lenders to the sector tend to have negative pledges within the facility documents, and to the extent that they said no, it's difficult to see how the university could grant additional security to another party, including the USS. A second implication might be what would be the impact on debt pricing. Employers agreeing to the proposals put forward by the USS would mean that the lenders would, in effect, be sharing security with another party. On the other hand, if the employers didn't agree to the proposals, then the likelihood is that it's going to lead to a significant increase in contributions, which will have an impact on cash available for debt service and other purposes. And under either of those two scenarios, there could be an impact on the pricing of the debt. And a final question, I guess, is the ability to which the assets of a university can be granted as security. The university estates have been built up over a long period of time, and they include a number of donations from various parties. And there could be underlying constraints such as historical covenants, charity trust issues, and permanent endowment, which could prevent those assets being offered as security. And this would only become apparent once the legal diligence was undertaken and completed. On the right-hand side of the scheme, just very briefly, I'll just touch on some of the considerations for the other three university or types of university scheme. So starting off with the in-house schemes for the pre-92 universities. Should the trustees of such schemes see the new security being granted to lenders and to the USS, they may reach the conclusion that as a result of that, their own employer covenants are weakened, and the trustees may themselves ask for security, or otherwise they may set more prudent assumptions which would drive a higher deficit and an increased funding requirement. On the post-92 universities, the TPS itself is an unfunded scheme, so no issues with security. However, in recent years, the rates that employers have had to contribute has been on the increase. And I think the impact on cash flows would be the main consideration for that one. And on the local government pension schemes, administering authorities are increasingly applying more bespoke approaches to different groups of employers, or the funding approach for different employers. And that, for example, could mean applying different discount rates to different types of employers, or by allowing employers different rates of, different maximum recovery plan durations. Not specifically in the HE sector, but we have seen instances in the LGPS whereby offering security, the employer has been able to obtain more favourable discount rates, or indeed a longer recovery plan duration, which just helps them to manage the affordability and gives them more flexibility around contributions. And that may well be something that universities would wish to consider at some point in future. Yeah, so the third point that I mentioned I would touch upon were the provisions of the Pension Schemes Act 2021, which received royal assent in February of this year. The Act introduces some new criminal and civil penalties which can be committed by any person if they enter into a corporate transaction or assist in a transaction that materially weakens the ability of an employer to support the pension scheme or prevents recovery of an exit debt. In terms of punishments, penalties include unlimited fines and/or 7 years in prison, and that can apply to directors, lenders, pension trustees, and advisors. And such transactions could conceivably include the granting of security over the assets of an employer. We expect that the criminal sanctions will be reserved for the worst cases rather than normal refinancing activity. And TPR has set out a draft policy on how it would expect to apply these new powers. Another requirement of the Act is that the granting of security over an employer's assets has become a notifiable event. So it is now something that the regulator would need to be informed of. And the Act also introduces two new circumstances whereby the regulator can issue a contribution notice, which is not a new power, but it's new scenarios and new situations whereby that same power can be applied. So it's a broadening of that power. And again, that could be applied in situations where there's refinancing or granting of security. I've set out the two new scenarios on the right-hand side, but I won't speak to them verbatim. That's all I had to say for today. Thanks for listening, and I'll now hand back to James.
That's great. Thanks, Mark. So when we set out, we said we'd introduce ourselves, and you've now met a few of my directors and partners. While I may not have had a cast of thousands sitting behind this team, I do have a team of 300 specialists in education who spend a significant amount of their time in the sector, and most importantly, work as a single expert team across all disciplines. Matthew explored the landscape and some of the lessons for reorganisation. Richard and Jenny looked at operations and financial effectiveness, and Mark highlighted some of the pension requirements and issues. The panellists and Tim Betts, one of our colleagues, another partner in our education team, will join me and we'll move into the Q&A session. Can the panellists now come on video, please? We have had one question through the Q&A, and we've had a few questions put to us in advance, and we will look to move through those now. The first question is, I'm interested in your view of the future of the HE market for restructuring and turnaround. Matthew, will you pick that up, please?
Yeah, thanks, James. I mean, it's obviously a very wide question. So, I mean, that would require me to sort of make a few predictions as well as observations. But I think the way to answer it, at least to begin with, is to kind of consider the landscape of HEIs themselves. I think it's really important. As I think a lot of people on this call will fully understand, HEIs or HE as a sector is far less homogenous than further education as an educative landscape, because it encompasses a really sort of massive variety of legal structures. So, I mean, that's from kind of royal chartered institutions all the way through to the kind of GSMs of this world, the private equity owned providers, the for-profit side, so and pretty much everything in between. So that's probably quite relevant to restructuring, turnaround, etc. And it's probably one of the main reasons why it's the Technical and Further Education Act and not the Technical and Higher, or Technical Higher and Further Education Act. Maybe there were just too many letters in that acronym. So I suppose it's that very diversity, and that's set against a backdrop of competition, sort of both national and international, that makes it seem to me that HEIs might just want to get on the front foot, particularly where debt service, and I mentioned the level of debt within the sector, and where that debt service is a question that needs to be answered. So I'll repeat it. So effectively, a few of my predictions. There's going to be a move to more corporate style relationships, including business reviews. There's a learning curve for lenders and institutions alike as to the expectations of an estate strategy, and a potential grinding of gears between stakeholders who overlook at their peril the potential impact on students. So just to keep it quick, there's potentially a more dynamic restructuring and turnaround market where effectively nothing's off the table. Okay, thanks.
Thank you. I think that leads into one of the other questions, and I'm going to put this one to Tim. How much time does it take to manage stakeholders, and can I lead this, or do I need support? Tim?
Thanks, James. Morning, all. In our experience, stakeholder management and interaction is a significant and important work stream in its own right. I mean, in any given situation, depending on the specifics, there will be a number of external stakeholders. So, including in no particular order, you have lenders, could be plural, you'll have pension schemes, you'll have the DFE, and different agencies within the DFE and the OFS and others as well. And at the outset, each stakeholder could have different requirements and also different timings in terms of committee meetings and reporting requirements that need to be achieved. So in our view, I mean, appropriate experience support can add real value in leading this work stream, importantly in coordination with the other work streams. Thanks, James.
Thank you. I think one for you, Richard. It'd be good to have a focus on opportunities as well as risks.
Yeah, thanks, Joe. Well, where do we start with this one? I mean, there's that saying that, where there's change, there's opportunity. I think that's true for all industries, but I think for higher education, I think there are a myriad of them. I think we've, Jenny and I touched on the opportunity to improve the effectiveness and efficiency of back office. So it's kind of providing an opportunity, but also de-risking your operating model at the same time. And I think more broadly, there's significant opportunity for really thinking about delivery models. So really stepping back and thinking about the what's, the hows, the when's, who's, where's, and I'm sure I've missed another why's of how service is actually delivered to students. And that can cover all kinds of different areas. And I think COVID's been a significant catalyst for really starting to think about what the art of the possible is. So there are significant opportunities around innovation, around how students are served. Technology clearly has a significant part to play within that. And more broadly, I guess from a sort of top level element, the ability to open out service delivery to a more international market also raises opportunities. But if we kind of go back to thinking about operating models, if you sort of take it from the fundamentals, really rethink what your operating model needs to be, but also should be in the future, taking into account all the elements of change that are going on, those are the things that that will clearly throw out significant opportunities across the board. Jenny, have you got any other thoughts that we can add to that one?
No, I think you've covered it. The only other thing that might be an opportunity is looking more at the culture. So the culture of the organisation and potentially how ESG factors could be built in. So when we're looking at particularly non-pay costs, how those ESG factors can support the culture within the organisation. Yeah.
Thank you. There's been quite a lot of interest on the pension side, so I'm going to bring Mark in now. The first question, any views on the impact of the increasing LGPS deficit on university balance sheets and future covenant requirements?
Yes, so the balance sheet provision for the LGPS is basically an estimate of the institution's net liability to the fund. And it's driven by financial reporting standards, and it's also influenced by which administrating authority the particular institution participates in. So it's largely out with the control of the university. What I was alluding to earlier during the presentation, when I was speaking about potentially providing security, was more about the affordability aspects, and I'll just quickly cover that again. It's we have seen instances whereby granting security to the LGPS can result in the employer receiving a more favourable discount rate and or recovery plan duration, which just helps that institution manage the affordability of contributions. But as I said, that's for the balance sheet. I think it's mainly driven by factors that are out with the control of the institution.
Thank you. Now moving to some of the thorniest stuff, Mark. Pension reform in the USS. One of the questions that's come through, is it not time to grasp the nettle of benefit reform?
Yeah, it's a difficult one. There's clearly a lot of HR and legal aspects which are going to be very, very challenging. We've seen in the past any talk of reform in the USS, we've seen industrial action result. So that's a very difficult one, but what I would say is that the 2018 valuation already incorporated some quite significant increases in the contribution rates that were required by employers. And judging from the initial results of the 2021, under that scenario one that I mentioned, they were almost doubling. So when you consider that universities broadly pay about 54% of their income out in terms of staff costs, then I think when you start to look at those levels of contribution rates, they may be starting to become a bit unsustainable. So it's one that it's going to be not an easy one to resolve, but I think that's it is being considered. I know that UCA have mentioned it. I know that UUK have asked the USS to provide some demonstration of what the benefit structure might look like under the existing level of contributions and so on. So I think it is something that's being considered.
And just finishing on the pension side, then we'll just move on. But the current legal status of USS pari passu provisions?
I don't think it's necessarily a legal thing. It's a consultation, and by the way, the consultation is finished. So I think as far as the USS were concerned, it was in effect. I remember reading in one of their updates that they were saying basically a thank you to employers who had already started to report, for example, under the debt monitoring obligations. But the consultation, I think, was undertaken as part of the valuation, and I think there's certainly going to be ongoing negotiations. The valuation, I think, is supposed to be signed off by the end of June this year. Whether that happens or not, I'm not so sure. But I think that there will be ongoing negotiations on that, and that will probably be built into the schedule of contributions or the recovery plan at that particular time, at which time it will become legal.
Yeah, thank you. I can do like two last questions. One I'm actually going to answer myself. You seem very pessimistic about the future, and that's before consideration of possible further changes consequent to the autumn statement. Do you think HMG would like a wholesale restructure of the sector that is hamstrung by a governance model? I think if you have a look at the sector sort of dispassionately, stand back and look at the finances, we've got an increase in demographics in sort of UK students coming through. We've got the impact of Brexit, impact of sort of COVID on international numbers. But the UK side, or the English side as such, for HM Treasury, they've got some fairly stark choices, and there may be some changes coming through. It may be that Augur sort of aspects of that are sort of implemented, reducing all fees to 7,500. Do nothing, leave the fees at 9,250, but no inflationary increase. Reduce the 7.5, but maybe top up sort of high cost strategic priorities. One of the key issues is that the student debt is becoming HMT's debt. The write-off of the student fees, the current system is far more expensive than the old system. When the new system came in, the fees went up to a maximum 9,250. The intent was that there would be diversification within the universities of the setting of the fee, and there'd be sort of different levels set in different HEIs, and that's just not come through. Everyone has sort of moved up to the 9,250. The debt write-off, when this was put in place under sort of David Willits, the advice he was getting at the time was apparently that the debt write-off of the student loans would be about 30%. It's currently over 50%. And this is why it's sort of a very expensive system, and it's just unsustainable financially. So whilst that doesn't go to a wholesale restructure because of the governance model, there is actually a wholesale restructure potentially because of the finance model, and then that will impact and flow through the universities. The last question, I note that staff weren't mentioned as a stakeholder group. Can the team comment on this, given the imperative to optimise productivity and industrial relations in the context of restructuring and pensions reform? I think, Matthew, if you could answer that one, that'd be helpful.
You come to me on that one. I'm going to slightly beg to differ. Actually, both myself and Jenny in her presentation did both mention staff. Maybe we didn't put the appropriate focus on it. Clearly, yes, they are an exceptionally important stakeholder within the group. They're also clearly touched on through Mark's presentation relating to the USS, and there may well be other pension schemes within universities where that needs to be a consideration. On my kind of 10 lessons learned slide, one of the areas which, because I only picked on 3, one of them on there was communication throughout the organisation for a successful embedding of a turnaround. It's actually a long-held restructuring methodology that actually quite often, if you ask the people who don't normally get asked, they usually have the best answers. So I think that's an exceptionally sort of important factor of any form of reorganisation to make sure that they're part of it. There are significant legal and operational considerations when you do any form of reorganisation and restructure, including obviously the legal template of consultation, then going all the way through to how do you embed, as Jenny said, cultural change, and maybe factors that sit outside kind of accountants looking at numbers, ESG factors, maybe offering to the student and the community and to society as a whole. So yes, whoever the questioner was, you're absolutely right. Staff are a very key stakeholder. My view, though, is that position pre-exists the pandemic and has not been informed, accelerated, or changed by the pandemic. Okay,
Thank you. Somehow we've managed to come to 10:01 and we can bring this to a close. I'm very pleased with the timing of that and the fact we have had sort of quarter of an hour to respond to both the questions put in advance, and we have responded to all the questions that have come through this morning's event. Final point for me, just simply thank you for attending. Delighted so many of you joined today. You will be sent over the next few days a copy of the slide deck and also a copy of the video recording. If you do want to contact any of us, as I said before, very welcome to go directly to any of the partners and directors today, or just direct queries straight into me. So I will bring this to an end. Thank you ever so much. I hope you enjoyed the presentation and found it of value. Thank you and good morning.